Hi, Dan Ferris here. I'm the editor of Extreme Value, a value investing newsletter published by Stansberry Research. And you can find more about that at www.stansberryresearch.com. And today's video is inspired by a talk that I gave at the annual Stansberry Editors Conference earlier this week. The Editors Conference is an internal event only, and we just get everybody together and exchange ideas once a year, and these are the ideas that I had to exchange. And what I talked about was cyclicality and how you can make a lot of money in the stock market if you understand cyclicality and know how to handle it well. And the example that I began with is Amazon.com, which we don't normally think of as a cyclical business. But everything is cyclical to a degree, is it not? So I put up a chart of Amazon's share price from about 2001 or so into the present. So that's like $6 on the left of the chart and 1600 on the right, and it's just soars the whole time, pretty much. I asked the audience, what would you rather pay? 6? Would you rather be able to go back in time and pay 6, or would you rather just buy it today for almost 1600? Obviously a rhetorical question. Then I showed what happened to Amazon's share price before it was 6. So in 1999 and in 2000, it was extremely volatile, and it went to, like, just looking at the chart, I don't know what the actual numbers were, and it doesn't matter, 90 something, then 40 something, then over 100, then 40 something again, then over 100 again, and then down to 6 with all the rest of the internet stocks crashing at that time. So the point being, of course, that the $6 moment is not one where people feel like buying anything. The next point was that $6 Amazon moment happens all the time in other businesses, but people are generally just too scared to do anything about it. And the reason I think they're scared is because all they can see is the chart. All they see is the minus 90, well, in this case, minus 94% in Amazon, or minus 90, minus 80. They see maybe all the stocks in the industry getting absolutely murdered. You know, it's to get to that Amazon $6 moment, you have to endure something, and you have to watch something really ugly happening. And that takes a toll on people psychologically, and it makes them just never want to own the thing again until it's $1,600. And then after I showed that chart and kind of made that point, I just gave a bunch of examples. And recently in Extreme Value, in January in Extreme Value, we recommended a mining-oriented company. It's not a mining company. In fact, it has a wonderful low capex, high cash flow business model, almost no capex, high cash flow, royalty-like, not a royalty, but a so royalty-like business model, but mining related. So it got killed with all the other mining stocks. And the way to handle this moment is to understand the fundamentals. You can't handle it any other way. Trying to handle it with technical analysis is probably just as difficult at the bottom as it is at the top. I mean, I can't imagine how useless technical analysis was in 1999 and 2000, with stocks soaring and plummeting and soaring and plummeting and soaring and plummeting. Just useless. But I don't know. I'm not a technical analyst. I'm just looking at charts and saying, God, that was horribly volatile. And I did write about this in Extreme Value last year, I think. I wrote about Apple, and I showed what it was like to try to trade, not invest for long term, but trade Apple around the top at the end of the dot-com bubble. It was a nightmare. You very obviously just couldn't do it. On the way up and on the way down, it was ridiculous. Just way too volatile. Anyway, that's a side point. The real point is that, you're enduring all this, price destruction, but what you should be doing is asking and learning about the fundamentals. And at that $6 moment, by then, you ought to know what kind of business it is and what the industry looks like and what you think is happening in the industry at that moment and what is likely to happen in the future. And you can't ever get away from kind of, I always say we don't make predictions in extreme value. You can't get away from the stock market without having some kind of a view of the future, even if it's the view of this stock is so cheap, I know it'll survive and it's probably worth more, something like that. Is a conservative way of looking at the future. So what do you do? What do you do in the mining business to do what we did in the January issue of Extreme Value and find this wonderful business that I think is going to be a 5, 10, 20 bagger over the next decade and is very holdable because of the financial risk. This company's never going to go broke. Brilliant management, great balance sheet, gushing free cash flow, that kind of a thing. So what do you know, that's the kind of thing you have to know. You have to understand the business. You have to understand the cash generating ability and the financial condition and how the management has behaved in the past. And I've known some people in the management for 20 years, so that kind of helps me a little bit understand how they're going to behave. And then when you get a super good price at the bottom, you have all this fundamental knowledge about the business that will allow you to hold it if you haven't picked the exact bottom. And it's unlikely that you will, of course. Then we did the same thing in the March issue of Extreme Value with the shipping industry. And by the way, I showed a chart of the GDX, the big mining stock ETF that got murdered. It was down from 2011 to the bottom in early 2016. It was like the whole ETF was down like 73 or 76% or something like that. The whole industry basically just murdered. And the same thing in the shipping industry that we showed in the March issue of Extreme Value. And the shipping stocks were even worse. There was a shipping index that I put up on the screen earlier this week when I gave my talk at the Stansberry Editors Conference. And that was minus 96% for the entire industry. Okay? Lots of bankruptcies, lots of zeros, lots of, split adjusted, because they all have to, to survive now, the shipping companies have had to issue new equity. So, they have to reverse split so they don't have 1 billion shares. So split adjusted, stuff like from $2,800 to $5,000. And I promise you, nobody wants to buy that. But we actually did in Extreme Value in March. And I think we demonstrated that the two companies we recommended come with a substantial margin of safety where you're basically buying ships for 50% of the current market value. Okay? And to buy them new build would cost, say, roughly 3 or 4 times that. So, and at 1 times peak EBITDA, something like that, 1 or 2 times peak EBITDA. Really dirt cheap stuff with a great margin of safety. To me, very classic security analysis, Graham and Dodd kind of value. And I understand that a lot of you value investors out there don't like these cyclical businesses. I understand that. That's fine. You want to be like Warren Buffett. I get it. But I don't need to be like Warren Buffett. I want to practice value investing in a way that makes sense to me. And it makes sense to me to buy big iron, dirt cheap, 50 cents on the dollar. If you look at the current market, which is depressed, and, maybe 20 or 25 cents on the dollar looking at the overall, new build cost. So, we found these companies that were down, the whole industry was down 96%, and the companies were down, God, even more actually, these two. And we recommended them, and of course they've popped up recently, so I look smart, inside of less than a month. But I know it doesn't work that way, and they could be quite volatile, but we don't care because we've recommended paying so little for them, and their financial conditions are such that they could liquidate less than half their fleet, pay off all their debt, and still have lots of cash generating ships, at an average age of something like 8 or 9 years. When ships kind of last maybe 30 years at the outside, just say 25, 30 years before they're scrapped. So You've got these young fleets that could be partially liquidated to eliminate all the debt, and their competitors could liquidate their entire fleets and still have hundreds of millions or even over $1 billion in debt. So, um, there's no incentive whatsoever to build new ships. And the order book is at record lows. It's like 8% of the entire dry bulk fleet right now. So I think we got a couple of really good picks there. We got three really good deep value picks. And we did it by taking advantage of that Amazon moment when the thing gets destroyed 96% and nobody wants it. And yet we look at the business and we look at the cyclicality of it, and develop a little bit of a view about the future. And I think, and my final point this week in my presentation, after I pointed out that the same kind of values are starting, you can see in the natural gas producers, we're not there yet. I think we will be. And in the oil tankers, also not there yet, but I think we will be. We're starting to see maybe some of those happen. And retail got creamed a year ago, and we recommended a retail stock. So, it's not just these few industries. It's not just these individual companies. It's not just these few industries. Whole batches of industries do this every so often. And if you look at the Russell 3000 growth and value indexes, you see how these batches of industries work. The fast growing, high multiple, expensive, generally more expensive stocks are the growth stocks, and the lower multiple, slower growing stocks are the value stocks. And I am fully aware that these indexes overlap, but they don't overlap 100%. So you wind up where growth outperforms value for, say, a decade or something, like in the 90s. Then everybody gets tired of that because all the growth stocks crash, and what just crashed turns people off, so they turn to, in the early 2000s, they turned to mining and banks and home builders and, what they perceived as stodgier assets, and mortgages and things that they thought were safe income too. And then they did well for a while, and then Wall Street turned a lot of that stuff, banks and home builders and mortgages, into toxic waste. So investors puked all that up in the crisis, and they turned back to the growth stocks again. So growth has now outperformed value again, after value seriously outperformed growth, into the crisis. After the crisis, since the crisis, growth has once again outperformed value. So we're getting this tick-tock of history. It goes back and forth. I won't say predictably, but, predictably. And now we're in a period where we've seen, mining, shipping, retail, natural gas has gotten destroyed almost enough for me to get interested. Oil tankers have gotten destroyed almost enough for me to get interested. So there's whole batches of industries. Once again, the growth stocks are peaking out. And if you look at the NY Fang Plus index on Bloomberg, I'm not sure, you can probably get a chart of it anywhere. It's looking pretty volatile and kind of toppy, the way Amazon and Apple and stuff did in 1999 and 2000, just ratcheting up and down. So you're seeing that happen, and at the same time, there's whole batches of these kind of value type plays getting destroyed and becoming a lot more attractive. So that's where we are right now, and I think it's actually a great moment for value investors. I'm calling this the dawn of the golden age of value investing. And you could have, I don't think this age is necessarily any more special or different than the previous golden age. I could have said the same thing in 2000 or 2001, or really 2002. I remember fall of 2002, there were so many of these little net tech companies trading for less than net cash. So for a brief moment in time, those things don't last if it's a real business. So that's where we are. We are at the dawn of the golden age of value investing, and I think we've kind of proven it. At any rate, we've sort of put our reputation where our mouth is. We're contractually prohibited from putting our money where our mouth is. But, the skin I have in the game is my reputation as a stock picker. So We have really, and as usual in extreme value, we don't throw out stock picks like playing cards, one a month like clockwork every 30 days. We didn't recommend one at all in the April issue or in the February issue. We did one in the January issue, two in the March issue, and who knows? I may not do another one all year. I only recommended two stocks in 2015. Turned out to be the worst year for stocks since 2008. That stuff happens sometimes. You see risk everywhere, and you don't want to recommend anything. And let's face it, negative advice is the only thing that has any credibility anyway. Anybody can shove stock picks at you. So you don't know, as long as people are shoving stock picks at you, you don't know if they're good, bad, indifferent, or if they're taking advantage of you or what. But if they refuse to shove stock picks at you, then you know. That's how you know. When somebody says, don't buy anything, hold cash, which is what we've said a lot. Actually, I haven't said don't buy anything. I've said hold plenty of cash, only buy when you have a significant margin of safety. And, if you are up for the extra risk, if it's short stocks and, bad stocks and tough industries, the advertising industry has gotten pretty tough on everybody except Facebook and Google. And, the retail industry has gotten pretty tough on most companies. And so we've had some short ideas there recently. They haven't worked out great, but, I think eventually shorts are going to be the smartest thing that you'll do sometime in the next 2, 3, 4 years, whatever. But that's today's message. Today's message is when you see these $6 Amazon moments, do your fundamental work. Understand the business. Understand the industry. Understand where it's been, where it's likely to go. Is it disappearing off the face of the earth? You have to ask a question like that in an industry like coal. Or is it like dry bulk shipping, which is not disappearing off the face of the earth? And industries like mining, which is not going to disappear. And industries like natural gas production, which is not going to disappear. And oil tankers, which are not going to disappear. You see where I'm headed with this? As long as the industry doesn't disappear and you're careful about timing, don't be afraid to miss that first pop. Get past what looks like a reasonable bottom and get to the point where you can pay, 1 times peak cash flow, or, in the oil and gas, 2 times debt adjusted cash flow, something like that. Really dirt cheap. And that's when you're paying $6 for Amazon, effectively. So that's my message for today. Thanks for tuning in again, and I will talk to you all again very, very soon. Bye.